Stellantis has some excellent products. I mean, the Jeep Wrangler, if you get in that, it's a lot more than it used to be, but they also are putting more in the vehicle. So they're not undesirable cars, the Ram trucks, etc. Some of their old sedans, the muscle cars, still sell pretty well. So it's not like the consumers are turning their nose up at those vehicles and don't want to buy them. They're just mispriced. And if Stellantis doesn't want to provide incentives, then what they should simply do is cut the wholesale price to the dealer. Don't charge $75,000 for a Wrangler. Charge $68,000.
Today, I'm excited to sit down for another session with Alan Haig, the founder and partner of Haig Partners, a leading buy-sell advisory firm specializing in car dealerships. With a remarkable track record of over $11 billion in transactions, Alan shares his insights on why dealerships are selling at such a rapid pace and reveals the top performing and most challenging franchises in the market right now.
A big thank you to our sponsors for making today's episode possible: Lot Links, Car Dealership Guy Industry Job Board, and Haig Partners. And now let's get into the show.
Alan Haig back on the CDG podcast. Alan, welcome.
It's good to be with you again.
Good to have you on in person this time.
That's right.
So we're upgrading over here. One of our most anticipated episodes always, because you really deliver the goods. We're going to be talking about car market, M&A market, dealership buy-sell business, valuations, what brands are rising, what brands are dropping. I mean, there's always a lot of movement going on. So I'm really pumped about this. I think just to kick us off, give us an overview of the current car market, right? Where are we at today, very broadly speaking, right? And where have we come from in the last couple of years?
Well, the car market's shifting quickly. The pandemic was a major disruptor for all of us, but the car market in particular had a vicious downturn, I would say, at the beginning of 2020 when pandemic hit, and a lot of businesses were forced to be closed. And then governments realized that dealerships, retailers, to use Mr. Dahl's term, were essential businesses. People needed vehicles for transportation. They had to get to the hospital, they had to get to school, they had to get to their place of work. So the car market was severely impacted in the first half of 2020. And then that led to a big disruption in production. And so there weren't enough vehicles to go around at the same time where there was a massive influx of cash into consumers' homes from a lot of government support to people. So you had this mismatch between supply and demand, where there was enormous demand for vehicles, but very little supply. That led to a big spike in the prices of vehicles and the profits that retailers are making from these vehicles, as well as the OEMs. So from the second half of 2020, really to the end of 2023, were epic boom times in the automotive industry for retailers and for the OEMs, the manufacturers. That's now moderating because production has begun to catch up with demand. And some of that is just they're producing more vehicles, but it's also because demand has started to come down. Vehicles have gotten so expensive, the consumers are feeling pressures from inflation, et cetera. Their wages are not keeping up as much. So a lot of customers are having a harder time buying a vehicle today, just having a hard time affording it. So now we're seeing a shift in the market from where it was sort of a seller's market, if you will. Dealers could charge a lot for their vehicles because they didn't have very many for sale. So they had to match the price with the demand. And now that the demand is less, retailers are having to become a little bit more motivated in selling these vehicles, which means the prices are coming down on new units. The prices are coming down on used units. So it's becoming a little bit more affordable for retailers, for consumers. But at the same time, the prices and profits that retailers are enjoying are still about double what they were before the pandemic hit.
Wow. So double from 2019.
2019.
The profits at a dealership today.
That's right. Before the pandemic hit. And we have a lot of data here that we've been pulling together for our second quarter Haig report that we create that tracks trends in auto retail and how they impact dealership values. And so every quarter we crunch the numbers and we look at what's happening. And we've seen a significant deterioration in the profits for new cars being sold at dealerships.
Is this across every brand, or are you seeing this across specific brands, or where are you seeing this?
It's really across all brands, some brands more than others. So we can get into that in a minute in terms of how different brands are performing today. But to give you an example of the change of how profits for dealers have changed on a new vehicle. Now, this is a profit before they pay for advertising, before they pay for the salesman's compensation, before they pay for the inventory, storage expense, et cetera. But before the pandemic hit, the retailers, the publicly traded retailers were making about $1,900 in gross profit per car they sold that was new. That spiked to almost $6,000 in 2022. So they really had a lot of demand and not a lot of supply. So their profits more than tripled during that time. Fast forward to today, in the second quarter of 2024, the average gross profit per new vehicle was about 3,500. So down from almost 6,000. That's roughly a 40% decline, but still up from 1,900 before the pandemic. So they're still making about twice as much per car as they were before. It's just not 4 times as much car as we had at the very peak of the market for retailers.
Where do you see the industry heading over the next 12 months? This has been a very rapid shift where profits have come down very quickly as supply has rebounded and as affordability has become a bigger challenge in our industry, right? So you speak with so many dealers. I mean, you're on the front line, right? You are, working with buyers and sellers of dealerships. They're selling the most prestigious and, everyday dealerships in the country. You have to have a great pulse of this, right? So what's your outlook right now?
So now we get into what I'll call the micro level, where some prices are going to decline at some dealerships faster than others. So today, Toyota and Honda have very desirable products. They still are having some challenges producing enough units to meet demand. So that means that the prices that are being charged for those cars are still pretty stout. And the retailers are making very healthy margins at Toyota and Honda. And because there's so much demand and the vehicles are priced fairly, there are not that many cars sitting on lots that are owned by Honda and Toyota retailers. Now, if you go across the street and you look at a Stellantis dealership, that's Chrysler, Dodge, Jeep, Ram, they've got about 150 days supply of new units sitting on the ground. That's a terrible issue for retailers and for Stellantis, the manufacturer. They have far too many cars on the ground given the demand they have for them. And there was really, sorry to say, it was a problem of their own. They did it to themselves. Stellantis, they pushed the prices of those vehicles up so high, so much faster than inflation, that eventually they outran their customers' ability to pay for them. So when you raise the price faster than people's wages are increasing, you're going to have that mismatch between supply and demand. And if you don't cut production and you shove all those units onto your retailers, which is what's happened, you're going to have this big, massive lump of unsold inventory. And that stuff begins to age. It starts to smell bad. Consumers can tell. You go to a dealership, you see a 2023 model that's still new. It's been sitting there for over a year. Something's wrong with it. How are you going to get somebody to buy that vehicle? You're going to have to discount it significantly. So the profits per vehicle at Stellantis dealerships is going to be a lot lower than it is at a Toyota store or a Lexus store, for instance, where inventory is pretty fresh.
And the CEO, or at least I get messages from lots of people who work at Stellantis corporate, and they're telling me that, the CEO is very against adding more incentives. He has just said, hey, this is and I quote, they said it's like a sales and marketing problem, which I don't even know what that means, because to me, incentives are marketing, or in a way. But nonetheless, it seems like there's internal friction over there, which wouldn't surprise me given, how poorly the brand is performing right now. Given your experience, what happens next? Like, is it just Stellantis dealers and Stellantis taking a bath for the next 12 months before they rebound? Because, the auto market is very cyclical. Like, what happens next in the industry for Stellantis dealers, as an example?
They're both going to suffer for a little bit. And Stellantis has some excellent products. I mean, the Jeep Wrangler, if you get in that, it's a lot more than it used to be, but they also are putting more in the vehicle. So they're not undesirable cars, the Ram trucks, et cetera. Some of their old sedans, the muscle cars, still sell pretty well. So it's not like the consumers are turning their nose up at those vehicles and don't want to buy them. They're just mispriced.
Yeah.
And if Stellantis doesn't want to provide incentives, then what they should simply do is cut the wholesale price to the dealer. Don't charge $75,000 for a Wrangler, charge $68,000. And that will increase sales and begin to, it doesn't do anything for the existing units on the ground. They're going to have to put incentives on those, because I think a lot of Stellantis dealers have just stopped ordering vehicles because they have to clear out the existing cars that they have.
What other brands right now are you seeing performing poorly in the market? Nissan's
having a hard time. It's the same issue.
Why? What's going on there?
Well, I think it's not so much that they've priced their vehicles so high. I don't think they've outpaced inflation. And fortunately, Nissan still has some products that are affordable, to consumers. They still have cars you could buy that are in the 20s. But a lot of their products are just a little bit too expensive, and they're not special enough to get someone to come buy a Nissan Altima as opposed to a Honda Civic or a Toyota Corolla, for instance. So they also have aging inventory, slowing sales, et cetera. And I think that Nissan will fix it. And both these brands that I mentioned, Stellantis and Nissan, are probably the two brands that we've seen most over the years have these boom and bust cycles. And it wasn't too long ago that Nissan dealers are doing much better than they are today. So I feel like both brands can fix it. It's really a function of, if you don't have really desirable product today, you're going to have to incentivize the consumer to take it. If you don't have a desirable product and you're charging a lot for it, it doesn't take an economist to tell you that
of course
it ain't going to sell very well. And that's what we're seeing with both those brands today.
Again, given your proximity to the dealer, because you're on the front lines of these buy sells of the dealerships, are you seeing, like, when I hear Nissan is performing poorly, Stellantis, I think deal, right? Is this a time for someone potentially to want to buy into one of those franchise, or at least look for an opportunity? Or if I'm a consumer, I might say, oh, if they're performing poorly, that means they may put some deals on the horizon. So I'm curious to know, from your perspective, are we at that point yet? Are you seeing interest in buying these franchises from the dealership community, or are we still at the point where it's, people are, hey, I want to get rid of this franchise, I'm not interested? Where are we at in the cycle?
Well, so from the consumer standpoint, there are some deals that I'm seeing out there. I mean, we've been involved in selling some of these brands, and when we go to closing, sometimes the inventory is there and it's marked down significantly from the original sticker price.
You see, yeah.
So
what have you seen?
Well, there's a Chrysler, I guess it's the Pacifica minivan they have, which is a hybrid.
Yeah.
I think it's something like $24,000 off the original sticker.
Yeah.
They're just so dead otherwise.
The question is, like, what's the actual price though? Right? Because they've jacked it up 49% since 2019.
Yeah. So, when it's around 40, maybe that's the clearing price. When it was 67, it wasn't going to sell. So I think from the consumer standpoint, we're going to start to see some quote deals on those products. Now, from a dealership buyer, somebody's interested in buying a store, we are seeing a shift in the market. So the last 18 months, our firm, we were fortunate in that we were able to represent owners of dealerships, and we're able to set record high transaction values for our clients that own BMW stores. That was Vista and South and down in Miami. We set a record high value for Stellantis dealership. That was in Lake Norman in North Carolina. And that was about a year and a half ago. So it's amazing we go from record setting to troubled in just 18 months.
But by the way, what drove that? Like, was that driven by higher sales and profitability, or have the brand's multiples on EBITDA expanded? Like, what's driving that?
Well, so the record high prices were set because the profits per store skyrocketed.
Okay.
So if I look at the profits per store before the pandemic, the average publicly traded dealership was making about $2 million per store.
Okay.
And then during the pandemic, that reached as high as $6.7 million per store. So more than tripled, right? So if we were selling a store in 2022, 2023, the very beginning of 2024, that's when you had a combination of record high profits per store, but also dealership buyers who had 2, 4, 6, 8, 20, 50 dealerships already. They were generating massive amounts of excess cash, more than they could use for paying taxes or buying yachts or
so reinvesting
whatever.
in additional dealerships.
Yes, they had a massive amount of cash sitting on their balance sheet. It wasn't earning them really anything back then. And so what were they going to do with it? So a lot of them chose to buy dealerships.
Pay more for dealerships.
Right. And if you were a special dealership, we saw Al Hendrickson Toyota down in South Florida. It was the number 2 store in the country. That brought a record high value for a Toyota store. Earlier this year, we sold Hollywood Kia, which is the number 2 Kia store, I believe it was, in the country. That set a record high price for Kia. So that combination of really high profits, along with buyers that were flush with cash, their pockets were stuffed with a lot of profits. That was a very productive combination that led to these record-setting prices.
This episode is brought to you by Lot Links. Dealers, when you look onto your lot, do you see risk? Every day, almost half of a dealer's inventory is at risk of aging. That's an average of a $1,500 hit on your gross profit per vehicle. But savvy dealers can avoid risk and get that money back. Introducing LotLink's Sentinel, the first and only AI inventory management solution completely focused on predicting and mitigating your carryover risk. With a decade of machine learning optimization behind it, LotLink Sentinel allows dealers to launch separate strategies for each individual VIN and ensure they sell faster and more profitably. All this so you can turn cars 7 to 10 days sooner and protect your margins. Stop accepting unnecessary risk and start controlling your inventory. Get the LotLinks effect with LotLink Sentinel. Visit lotlinks.com/sentinel to learn more or click the link in the show notes below. How do you explain, because the market has undoubtedly slowed. I spoke with a top 25 dealer and they told me they're pretty Stellantis heavy. I'll disclose that, but they said, hey, it's brutal right now. Like they used words that I don't remember them ever using these words. So how do you explain that buy sells, right? Dealerships being bought and sold in the industry, consolidation is only down 15% year over year, which to me doesn't seem like a lot. Well, and if you could actually table set and give us the numbers here, a little context, right? But it seems like the market is still pretty strong in light of all these affordability, in light of interest rates being at 20 plus year highs. How do you reconcile that?
It is still a really good market if you are somebody who's thinking about exiting. And it's still a good market for buyers because they can still get a higher return on buying a car dealership than they can just about any other asset. I'll come back to that in a minute.
Yeah.
But before the pandemic hit, for roughly 10 years before, the number of rooftops that were being purchased and sold in this country, number of dealerships, was about 300, 350 dealerships per year were trading from one owner to the other.
Mm-hmm.
During the
This
pandemic.
was before the pandemic, 350 dealerships per year.
That's right.
Okay.
During the pandemic, that number exploded. In 2021, we saw over 700 rooftops trade hands.
Mm-hmm.
Now that's more than double there was the number
so people
before.
were cashing out and others were just expanding, reinvesting profits.
Yes. So the people cashing out were saying, whoa, I'm only 62, but the value of my business has more than doubled. So I'm out. I just advanced the age of my retirement. I can go to the beach. I can go start my charitable charities, whatever else I want to do. I now just advanced my retirement. I got several years of my life because of COVID, ironically.
Yeah.
That number has stayed elevated, the number of stores being sold, because dealers had a lot of confidence in the business model. So it wasn't just COVID. I think it was also that certain other risks in the industry began to dissipate in the minds of dealership buyers.
Mm-hmm.
So for instance, autonomous vehicles. Some people were afraid that retailers would go away because everyone would just press their button and have an Uber come and take them. And people realize like, oh, during COVID, it's kind of nice to have your own vehicle,
Mm-hmm.
right? I don't want to be in a car with someone else or a car that someone else has been in. There are a lot of other risks that sort of have gone away in the minds of dealership buyers. So they became more confident in this business model. So they wanted more, not less. So when a dealership came up in their market, they were willing to bid aggressively to get it.
Mm-hmm.
And I joke, I feel like for some retailers, it took me a long time to realize this as a kid. When I was playing Monopoly, I would sort of skip over the yellow properties because I wanted to get the green properties. So I wouldn't spend on the yellow properties. And then I realized really the way to win Monopoly is whatever you land on, what do?
You buy it.
You buy it. Okay. I was a very slow learner of Monopoly, but I think that's that's not absolutely true in the dealership world. But I think for some people, they said, hey, if a BMW store comes up in my market, it probably won't come up again for sale for 20 years.
Mm-hmm.
If a Subaru store I've had my eye on, forever comes up in my market, same thing. If I don't buy this one now, I may never have a second opportunity. So if they have the cash, they have the confidence, and now the opportunity is coming because the supply of stores coming into the market was
Mm-hmm.
increasing because the value was higher. Again, it's kind of the economists love this industry because, the law of supply and demand is
Mm-hmm.
it's powerful and it's evident here. That is one reason why so many more stores have been sold the last 3 years than ever before, because the value then went up so much, people could afford to sell them and retire.
Mm-hmm. The industry is grappling with, affordability crisis, insurance prices going up, uncertainty in the future, disintermediation, direct to consumer, electric vehicles, internet, AI, blah, 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 blah. You're speaking again with many dealers on a daily basis. Is there fear within the dealer community? Is that leading to some people to wanting to sell, or is it more natural succession? Like, what do you view as the driver of sales? And specifically, is fear being a driver or playing a major role in people's desire to sell nowadays?
I think the main reason that people choose to sell is usually age. They get to the point where they think, I have been successful in this business. I've gotten a lot out of it. I've put a lot into it, but there are other things that I want to do with my time or my money, or I just need to get liquid to prepare for what may happen to me, so my family is taken care of. Because these dealerships, I refer to them as sticky assets. They're hard to get and they're hard to get rid of. So if I owned a group of stores and I died tomorrow, to sell those businesses could take 6 months, could take 6 years. Maybe my heirs are fighting amongst each other for them. I'm using some ugly situations between families that own stores.
Yeah.
So it's a lot easier to own a pile of cash than it is a pile of car dealerships. So age, I think, is the main reason. There are some concerns that people have about the future of auto retail. And the families say, hey, we have 100% of our net worth tied up in these buildings and these franchises. And maybe this net worth is worth 10 million. Maybe it's worth 100 million. Maybe it's worth $1 billion. And we've seen all those in the last year in our business. And maybe in the future, they'll be worth more than they are right now. But the odds are they're going to be worth less, because we're already seeing the numbers come down for dealership values. So I think some of them are saying, I can't predict the future, but I know the present is pretty good. So let's not take the risk. Let's liquidate these dealerships and invest it in a diversified portfolio of real estate, stocks, bonds, private equity, venture capital, whatever it is they want.
And are those sellers, are they specific franchises, or is it all over the map?
It's all over. I mean, I think some people are selling businesses today that are a little bit distressed. We're seeing larger dealership groups divest some struggling franchises.
And it's driven by the franchise, or is it driven by the management or anything else? Or
it's a little bit of both, and they're related. So years ago, I was at AutoNation. I was at AutoNation twice in my career, but the first time I was there in the boom time, we bought, I don't even know how many stores within the first 2 or 3 years of that company's existence, hundreds. Didn't really have a plan for what to do with them. The second time I was there, over a 4-year period, we bought 14 stores and we sold 56. And some of the 56 were ones that I had bought the first time I was there. And so was that just the brands that had declined, or maybe we hadn't done such a good job managing them? And I think what almost every public company CEO will tell you is that larger dealership groups do better with larger dealerships. The bigger the store is, the easier it is to run.
Economies of scale and all that?
It's economy of scale, but it's also just, it's not as dependent upon the talent of the general manager. If I have a store that's selling 300 new units a month and somebody steps out, I probably have a talented assistant manager or sales manager that can step into that role.
More redundancy, more systems.
Yes. If I've got a small Stellantis store in a small market with 30,000 people and that general manager leaves me, how am I going to find a replacement? I don't have lots of assistant managers in the store who would be willing to move to that town and take their family, say, honey, we're moving to such and such, small town. We're selling the house. We're leaving your parents and your friends. Come on with me. I think a lot of people will be showing up solo. So larger stores are easier for larger companies to run. So we see this regularly, that a company will buy a group of stores, 10, 20 stores, and then end up divesting some of the weaker ones. It's just not a good fit for them. So now we're seeing weakness in Nissan and Stellantis. And I think there are going to be dozens, if not hundreds, of those franchises that shift from large dealership groups to small dealers. And we hear a lot about affordability for customers, how hard it is for them to buy a vehicle. There's also a lot of discussion in our industry about how expensive dealerships have gotten, and how can an average person, man or woman working in a dealership today, ever hope to afford one? And these types of dips that are happening now with a couple franchises, to me, these are the opportunities for younger, less capitalized dealers or individuals to become dealers. So, for instance, 3 years ago, the average Stellantis store might have been making, I don't know, $3 million, could have been worth $15 million in Blue Sky, maybe have $10 million facility. So you're $27 million to buy that business. Today, still going to be the same amount of real estate, still the same amount of working capital, but it might sell for $2 or $3 or $4 million in Blue Sky.
And can you just define Blue Sky for anyone that doesn't know what that means?
Sure. I'm sorry. Blue Sky is basically intangible value. So the amount of money that someone have to pay a seller in order to buy that business over the tangible value, like the parts, the cars, the furniture, the computers, things of that nature. It's basically the right to own that franchise and operate there.
Another question that came up to me recently was just about dealerships themselves and facilities, right? Because you see the automakers are consistently pushing, upgraded facilities, newer looks, a more modern experience. On the other hand, agency models, you're seeing more murmurs about this. You're seeing more manufacturers talk about, being involved in the retailing process in some way, somehow. What's your take on just these dealerships that are spending and dealers being required to spend all this money on upgrading their facilities? Do you think this is like a hedge for the future, or is it more of like a moat where as the car buying experience becomes more experiential and, more of a, it's not just transactional, that can actually, be defensible for the dealer? Where are you on the spectrum with this topic?
I think that some manufacturers have quite reasonable facility designs and requirements on their retailers, and they should have expectations. The retailers representing that brand needs to be an attractive, functional, desirable place for a customer to come, and for workers that want to come and spend 8-10 hours a day. So there's some brands that we see being very reasonable with this. So Toyota, Honda, Subaru, Nissan, and there's some brands that are crazy expensive, like Genesis. To build a Genesis store, it's about the most expensive per square foot dealership.
Why? What is it? What's so specific? Is it the facade, or what is it?
The materials, the design, etc. If you ask somebody building these stores, it costs more to build a Genesis store than it does to build a Mercedes store. Now, that's to me to be a waste of money. I don't think the consumer is demanding that you have, 1,000 square foot building costs for some of these locations. So unfortunately, retailers do have to invest in their business, keep them fresh and desirable. But I don't think that there needs to be another image upgrade every 10 years. So, Mercedes years ago had Auto House 1, and people had to put this black exterior or blue exterior with blue poles. And the new CEO came and says, no, I want to have black Alucobahn and black poles. So the retailers 7 years later had to go and change the color on their facade. Hyundai went from blue to tan to black, or I think it was. So some factories I feel like are quite adept at spending somebody else's money. And what they may not appreciate is if the retailer is spending money on Alucobond and tile, that's less money they can spend on training, on marketing, on providing a better customer experience, because they only have so much profit coming out of the store. So if I have to pour a lot back into the building, can I pour a lot into my people and my customers? There's going to be competition for that. So it is part of this business. The retailers do have to invest. Some factories are much better partners to their retailers than others.
You also review lots of financial statements. I'm curious to know how are you seeing dealers investing in, EV infrastructure, stuff like that. I mean, again, Ford had their program. I think it was called the Mach-E, or I forget the exact name of it. Was it the Mach-E program? But they had their program where dealers invested, as much as, or over $1 million in some cases, per dealership. Then they pulled it about a year and a half after. And dealers were pissed, rightfully so, because you just had that, massive cash outlay that, oh, well, this is not the program that you need anymore to sell these EVs.
Yeah.
This episode is brought to you by my very own car dealership guy industry job board. CDG Jobs is revolutionizing how talent connects with top automotive companies. Here's a shocker. We're not using any fancy technology or AI. We literally built a simple HTML job board. That's it. But it works really, really well. And the best part, it's completely free for CDG listeners to post and fill positions at their firm. So I'm sure you're wondering, what sets us apart? Well, when companies hire through CDG Jobs, they're choosing from a pool of the most informed candidates in the industry. Don't wait. Whether you're hiring or seeking a new opportunity, visit cdgjobs.com today or click the link in the show notes below. That's cdgjobs.com.
What are you seeing right now in terms of EV investments, or is it still are dealers doing it, not doing it? Where are we at?
Well, that Ford program you referred to was painful to those of us in the dealership buy-sell world, because we had 2 transactions that included Ford stores. The day that program was announced, that the investment per location was going to be $1.7 million between the hardware that had to go in and the training and changing the height of the doors and buying a forklift and building a separate building to store the batteries. There was all this required infrastructure to be installed in order for the dealer, the retailer, to be able to sell any EV at all. We had 2 transactions where we'd already set the price. As soon as that story hit, the buyers called us and said, "Hey, $1.7 million, that's coming off the purchase price." And we said, "Oh no, you're going to get the benefit of that $1.7 million because you're going to be able to sell all these EVs." And they said, "No, if you look, Ford's already announced that production is going from ICE to EV. This is not additive. This is not incremental. This is just simply a cost of doing business." And so we're not paying that $1.7 million. That's got to come from the seller. And the sellers balked. They're like, "No way." And so we had 2 deals crash because of that.
Wow.
So I estimated, all right, that's at least $1.7 million. I think they're roughly 3,000 Ford stores. So that's like $5.5 billion of franchise value that poof, disappeared that day. If you do the rough math, 5.5 billion, I think is the math.
Wow.
And now
how Ford blew $5.5 billion.
Well, I have to check the math. I haven't got my calculator with me.
Value
I'm going to ask my analyst team back in Fort Lauderdale to run the numbers for me. But since then, now that was also when Mr. Farley was saying, "I'm going to divide my company up into 3 sections." This is at Ford. There's going to be an EV section, an ICE section, and a commercial section. And I, Mr. Farley, am going to run the EV section. He's realized that EVs have been a disaster in terms of profits for really every OEM except Tesla. Tesla's the only company that's making.
Well.
Yeah.
Do you think it's just the necessary? I mean, Tesla lost money. Again, the critics would say, or, if I'm being devil's advocate, sorry, I would say, well, Tesla lost money for many years as well before they became super profitable. Do you think that's an anomaly, right? They were first to market, or they weren't technically first, but they were the first prominent to market. Or do you think that legacy manufacturers can follow in their footsteps?
I mean, Tesla had a lot of subsidies to start, right? They got a massive amount of loans to build an EV, and they took time to develop a really good EV that when it hit the market was unique and desirable and performed incredibly well. I'm thinking about the Model S, right? Now that was a high-end unit, but still they put out a high-end unit that was in demand for those folks while they were building a higher volume, which is the Model 3 and then the Model Y. I think had the other OEMs followed the same path, which is, hey, we're going to continue with the ICE and we're going to introduce one vehicle and make sure it's really good
before expanding.
Yeah, and it functions better than other products available on the market. Then I'll come in with the second product. Then I'll come in with the third. Instead, they said, hey, we're going all the way.
Oh, yeah.
We're going to drop these ICE things.
Very risky, yeah.
Yeah, and I think it must have been very hard to be a Mary Barra or Mr. Farley at the time, because you look at Tesla stock. I mean, we joke about how it, took off like a rocket, like SpaceX, but it was and it is so much more highly valued than any of the legacy OEMs.
Yeah.
So you say, it was like, well, if you can't beat them, join them. We'll just copy Tesla. We're going to make all EVs. Maybe we'll go around our retailers too while we're at it.
Yeah.
That was maybe their wish. And then the reality is maybe Tesla's getting that 10% of the market that really wants to have an EV and wants to have a direct consumer model. Maybe the rest of the market is not yet there. Maybe they still want to have affordable vehicles that can drive 500 miles. So I think that they didn't try to build into the demand that was there. They just tried to, here's the supply. Now you got to take it.
So tell me more about Ford, though, because recently, from my understanding, and as you were telling me earlier today, is that Ford is actually rebounding a little bit now, right?
We are.
For the last couple podcasts we did, it wasn't pretty, right? You gave us an M&A update, and Ford was not in good shape. And plus, I didn't even need to hear it from you. People were telling me directly, hey, I will not touch a Ford store, right? Big dealers, small dealers, anywhere in between. So where's Ford at today? It seems like there's been some shifting over there.
I think that retailers are feeling that Ford is coming back towards what makes sense.
Well, what does that mean?
Providing the vehicles that the customers want to buy and not trying
just listening to the customer. It's actually that
listening to the customer. And Ford's got some really good strengths, powerful strengths.
Such as?
Well, the F-150, top selling vehicle in the world for a long time. And, we think a lot about, what consumers are driving, et cetera. But the Ford commercial side are vehicles that are sold to people who make their living by driving those vehicles, using those vehicles. So they're willing to pay a lot for a quality product. They drive that vehicle, they use it quite heavily. So it's being serviced and it's using a lot of replacement parts. And I don't know what the percentage profit for a retailer comes from replacement parts, but for Ford, I think it's a pretty big percentage. So retailers that we have that have Ford dealerships are making really strong margins on the trucks and the SUVs, and they have very powerful fixed operations. So there's a dealer in Dallas, Texas, who's well known to many people, Sam Pack, and he's one of the best Ford dealers in the world. And he talks about, I asked him years ago, are you worried about autonomous vehicles? Are you worried about EVs? And his response was, not really.
Why?
At least in his market, consumers drive a long way.
Yeah.
Like a 300-mile range is not sufficient for someone living in Texas, especially somebody's going to be hauling a trailer.
Yeah.
And for those consumers that have to have income, right? Their truck is what provides them income. In his mind, they're gonna continue to buy that product and service that product through his dealerships. And so I think that confidence in the Ford brand is coming back. And I think also some of the stuff that Ford was trying to do to improve its share price. I mean, they're doing what's in their interest, right? Now they're realizing like, oh, that didn't really work. So what are we going to do? Well, okay, we'll create hybrids, F-150 hybrid. So that provides the power and it provides the range, and it's still affordable as opposed to the Lightning.
Yep.
Which would turn out to be a really good car to take to a cookout, right? It was an incredible tailgate machine, right? With all the power, and you can open up the front and you got a cooler that you can put a couple cases of beer in. I mean, that thing, that's the machine to have if you're going to a football game and you want to spend the day.
Yeah.
But if you're going to haul a couple snowmobiles in Minnesota to your cabin,
no good.
Not a good choice.
Tell me more about, so Ford is definitely, rising again, or at least they've kind of changing the direction, which is good to hear. What other brands are super high in demand right now? Any outliers, or are we, still with the traditional, Toyota, Honda, Subaru, or anything? Give us a little overview there.
Toyota and Lexus are just performing extremely well. I don't know of many more good things I can say about that company.
And when you say performing extremely well, like what are valuations right now, or give us like some.
Well, from the consumer standpoint, they have the best model lineup because they're really delivering anything the customer wants, particularly hybrids. That's really where they have almost every vehicle they have is a hybrid vehicle now. You can still get all gas if you want. They have maybe one or two just all EVs, but it's really almost every vehicle they have you can get in a hybrid now. So that gives you the power, the range, the reliability, and an affordable price and the economy. And then, so not only the consumers liking it, they're not overproducing. They're continuing to innovate and bring in new products. The 4Runners coming in now.
Correct.
Lexus is getting the GX. The business model for retailers remains rock solid. They still view the retailer as their partner. That's how they're being successful in delivering value to the customer through their retailers. And so retailers feel like Toyota's actually helping me to become a better business person. Instead of some factories, I think the retailer feels suspicious of, like, are you trying to go around me? Are you trying to sell directly to my customer? Are you trying to take profit out of my pocket? What is happening here? There's always this tension that exists between many other OEMs or manufacturers in their retail network.
So, we spoke with Tom Dole earlier today, and I think if I've learned anything today about this business, it's that it seems like if mom and dad are playing nice, right, the manufacturer and the dealer, the customer experience is going to be pretty damn good. That's at least what I'm getting at here. Just again, it's every time, right? When the dealer and the manufacturer have a good relationship, the customer experience is just, that's the output. It's a lot better, at least.
It's a great point, because if I have a business and that I'm selling a vehicle that's in demand, that means my competitor down the street, they're in demand for it too. So I've got to do a really good job taking care of my customer, or they'll go across the street. He'll sell the vehicle to the customer. He'll get another one to sell. I still have the one that I didn't sell. So his sales begin to accelerate, mine's slow. Now, if there's so much inventory out there, which happens with, call it Stellantis or Nissan today, if a customer comes to me, I might rough them up to try to get them in a car, right? Because I got so much inventory. I got to make it his problem.
Yeah.
As opposed to, I really want this customer to come back to me in the future. I got to treat him very, very nicely. So the brands that we see, Subaru, Toyota, Lexus, I would say those three brands maybe stand alone in terms of viewing the retailer as their partner and really as their customer. So they're trying to please their retailer. How to do that? They have a business model that brings them customers, that has great products for the retailer to sell to the customers, and then has programs after sale that make the customer happy, whether it's great residual values, a very reliable product. Toyota has 2 years of prepaid maintenance included in the value, the purchase of the car. So the customer's coming back for oil changes, tire rotations, things of that nature, and further tying them to that retailer. So there's certain things that those brands do that, and Tom mentioned earlier, when you create a tie between the customer and a brand and the product, that's pretty powerful in terms of longevity and repurchase intention. And Subaru has probably done that. I mean, the fact that he could create, love at what makes a Subaru, I can't think of any other car company really pulling that off.
Tell me about, so we all know like Toyota has obviously performed super well. They lost a ton of market share in the last couple of years because they didn't have inventory, right? Now they're regaining it, or they're gaining a lot of market share back. Do you think that will leave any permanent marks on the brand, right? As a dealer potentially looking to buy a store, like, is there anything that they're currently doing that is concerning, or is the brand just performing, on all cylinders? What's your take?
I'm not aware of anything they're doing that I feel is a mistake. I mean, sometimes they come out with a product that is a bit of a miss. Maybe it's not priced appropriately. I think the Tundra is a tough sell right now.
Yeah.
It's an expensive truck. And I think people are looking at that and going, well, I'm going to get a Silverado or an F-150, for less. So there are some things I could nitpick on, and maybe Toyota dealers understand it better than I do. But in general, their heart, their intent, their strategy is about providing a great value to the customer and making the retailer their partner. If that's what they're trying to do, then you can't complain about really anything that comes if that's still the intent.
I think the other, we spoke about just the underperforming brands versus the overperforming or better performing brands. And another anecdote that I've noticed is that people will DM me on X or Twitter and they'll say, hey, I work at a blank store, let's say, Stellantis store, considering moving to a, blank higher performing store. So I just think that this is that death spiral, right? When you lose momentum as a brand, when you make, incorrect decisions, you can't fix that overnight. I mean, you lose talent. So you mentioned, getting those customers, trying to sell them a car. Like, this is real, right? People are looking left and right. Everyone wants to maximize their earnings. And one way you do that is by going to the, most desirable brand. So it's I definitely see it in my world, and, where, it can be from a salesperson to sales manager to GM, but it's very real and it's happening. All right. So I want to shift the conversation to just foreign entrants. In the last 6 to 12 months, we've seen the names VinFast. We've seen the names, Fisker with the bankruptcy. I mean, a lot of change with these new entrants. I also been saying that, in my opinion, it's never been a better time to be a new entrant in the car business because there's so much fluidity, right? With EVs, with technology, with the fact that we didn't have much supply over the last couple of years, which was a forcing function to get people to try new brands potentially that had supply. Are you seeing anything? Are dealers asking you about this? Are you seeing dealership agreements potentially for these new entrants from overseas? Anything like that?
I feel that some of the entrants that have come and failed, like Fisker, fail because they didn't necessarily have a product that was really superior or differentiated from what existed. They had a pretty cool looking SUV. They didn't have a good retail network. They didn't have a retail network at all, I don't think. It was poor experience. One of my teammates bought a Fisker and returned it in the first week because he could tell it was going to go bad. I think that there is an opening at the bottom end of the market. And this is where I think people are afraid of a Chinese invasion of automakers, of bringing vehicles
undercutting
in.
prices.
Yeah. I mean, I've seen some of the vehicles. I know some people, maybe you've gone to China and seen some of these products. They're not ugly cars. They're great looking cars. They have all kinds of tech involved in the performance, and they're half the price of a comparable vehicle in the US. Now, VinFast is an interesting example where it's not a Chinese company, so maybe it would avoid some of the politics of being a Chinese brand.
The tariffs and whatnot.
They've got some vehicles that are very affordably priced. I don't know if they're taking off yet in the US, but to me, that would be an entrant or at least a category that I feel is open. That maybe because of labor costs.
The low end of the market, pretty much.
Yes. If you could come in with a vehicle that somebody could buy for $200 a month through a lease, and it provides good basic transportation. You're not trying to be a high performance car. You're not trying to have the latest and greatest tech. Why even install a nav system in the vehicle anymore when we all have
I totally agree with you.
Why even have a radio?
I totally agree with you.
It's kind of,
you can save money. You can really
just have 4 speakers and Bluetooth and a little. They don't need a screen. That's what the phone is for.
Unbelievable.
So I think if somebody were to design a vehicle on the low end of the market, or we're also in some certain niches, like Ineos Grenadier has come out with a cool looking Land Rover product. Will they make it? Maybe. I mean, it's a $75,000, $80,000 vehicle instead of a comparable vehicle, which is a Land Rover Defender, which is probably 90 or 110, and maybe it breaks down, maybe it doesn't. So there could be some niches that new entrants come into, but I feel like it's so difficult to come in and take share profitably over a long period of time against some brutally good competitors, whether you're talking about Toyota, which I think invests more in R&D than almost any other company on the planet. How are you going to come in and outcompete them? You have Ford and Chevrolet that have these rock solid truck franchises. You got Jeep that has the legacy brand. You have Hyundai and Kia, which I think have got some really innovative styling, beautiful cars, interior and exterior. Those are exciting cars to look at now. So where if you're coming in new, what's your angle? Where are the niches that you could fill? That would be the only place that I could see somebody come in and be successful is in a niche.
On a different note, you wrote a letter to Elon Musk. So Elon follows me. So maybe he saw it. We shared it. But what was the outcome of that letter? Can you give a little context, like what you wrote? And it was pretty, I would say I was pretty surprised. I was like, okay, interesting, like cool shot. And it got some good distribution. So I'm just curious if anything came out of that letter and if you can share what the purpose of the letter was.
Sure. So the letter was a letter to Elon, and it was an invitation for him to join the franchise system to help turn.
Some people saw that and were like, woo, not happening.
Well, so
controversial.
I could see how if you were launching a company back then, that for Elon, it made sense to go direct to consumer. There was very little knowledge of electric vehicles back then. He thought that retailers wouldn't try to really sell his car. They wouldn't know how to sell it. And maybe he also wanted to control the customer experience. And I think that there's a certain part of the population that's comfortable buying a vehicle online, even if it's a $50,000 or $100,000 vehicle. But his sales have slowed significantly. In fact, I think he had a decline last quarter in his sales, and his inventory has ballooned. I think we estimate there's over $9 billion of units sitting unsold. These are no longer being sold at the factory and shipped directly to the customer. That period is gone. Now they're stacking up at lots really all over the country. There was a video I saw of some new Teslas, Cybertrucks, Model 3s, Ys, etc., sitting on just a random unsecured storage lot in Fort Lauderdale. And somebody had gotten spray paint and gone all of his vehicles saying "F Elon." So the market shifted a little against I think that business model. It's no longer working as well as it did before. So some of the complaints that I hear, some of the resistance about buying a Tesla is, I really want somebody to explain the features and benefits to me. I want to be able to go into a showroom and see it and test drive it. And I have this other vehicle that I kind of want to trade in so I can save some money on taxes and not have to do another transaction. And then if something goes wrong, and something will go wrong with it, I think that Teslas have got one of the lowest rated reliability records, or at least problems per vehicle. Consumer Reports is about the highest out there. So that happens. So if I have a Tesla dealership down the street from me, I feel more comfortable about purchasing that vehicle because I can go right there and get it serviced. But if I have to take it some off location place and it's going to sit back there and no one's going to communicate with me because I can't actually reach a person, that makes me less confident about buying that vehicle. So for all those reasons, not growing sales anymore, a certain percentage of consumers wanting a physical experience. And I think the majority of customers still today want a physical experience, and they're going to spend $50,000 or $100,000 on a vehicle. The uncertainty about what happens if the vehicle breaks, who's going to fix it for me and how and when. And then from Tesla's own desire to increase sales and not have all that inventory sitting on the ground, the invitation was to offer Tesla franchises to retailers. And I'm pretty sure that you'd get a lot of people today.
Take Tesla and actually attempt to franchise it.
Yes.
Just like, pretty much every other franchise out there.
Yeah.
Franchise, yeah.
So rather than having 17,000 retail locations selling against you, offer up a franchise to 1,000 retailers. And you could, within, I think, a matter of a year, have all those really talented retailers and the hardworking people that work for them and the technicians put down their wrenches when they're fixing a brand that isn't in demand today. There are too many Nissan stores, or too many Infiniti stores, or too many Chrysler stores, or too many Ford stores, too many Chevrolet stores, too many Buick GMC stores. A certain percentage of those take their sign down and put up the Tesla sign and retrain everybody on the new product, how to repair that product, how to sell that product. To me, that's a win-win. It's better for Tesla shareholders. It's better for auto retailers. Now we're all in the same pool, wanting the same thing, which is really to deliver the best customer experience possible. So I invited him to join. I offered to connect him with some of my retail friends. I probably spent 2 weeks writing that letter and making sure that it had the right tone.
Yeah, we did an article on it, so we posted it as well. It was good. And
after 2 weeks, a couple of days after it landed, he responded, and in 2 sentences, he dashed my dreams. He said, showrooms are for test drives only. It's better to buy online. That was it.
Epic. So, well, you got a response. That's epic. So,
I'm hoping that he'll consider, he'll keep that in consideration, because I do feel that that's the win-win. There are very few companies out there that are successful making and selling something to consumers. Most successful companies are good at designing, making a product, and then someone else sells it for them. I have a friend in Melbourne, Florida, a dealer there, and he says, the factory can't do nothing but make the car and ship the car. They're just in the way on everything else. Now, that maybe is a little bit critical.
Yeah.
I'm sure there are a lot of OEMs.
I've heard that, though. That's not, I've heard that kind of sentiment. So, all right. So my favorite part before we wrap up with closing thoughts, predictions. So next 12 months, what is going to change in the car business? Talk to me profitability, talk to me supply and valuations. What are we going to see?
I think we're slowly going to see a return to what we had before.
So that means more declines to come.
I think that dealership profits will continue to decline a little bit. The new vehicle margins will come down as the supply increases. That'll be offset if we have lower interest rates by more vehicles being sold. I think that the demand for stores will remain high, because I think that it still provides one of the best return on investments over a long period of time of just about any asset class that I know of.
Yeah. Tell me about it. I get the PE firms emailing me every other week. So it's every other week, some random PE firm reaches out like, hey, we're interested in buying dealerships. Just like these random notes from, like international, just firms that are looking to just get into the business. So.
Yeah. So I think that demand will stay there. So I think for those of you who are in auto retail now, I think it's going to continue to be a very good period. Dealership profits today are twice what they were in 2019. So if they drift back,
it's outpaced inflation though.
It's outpaced inflation. Yeah. Now, certain things I think are going to stick at a higher level. I don't think we're going to go back to 2019. I don't think.
Yeah.
Some of it is dealers have become more efficient. Some of it is, I hope that factories will realize that overproducing vehicles is a bad outcome. We're seeing that right now with certain brands that have overproduced. I think that cars will get a little bit cheaper for consumers, so that they're going to start to win a little bit. They've been punished through inflation and this lack of supply. They had to pay a lot of money for a new vehicle. They're going to get a bit of a break in terms of vehicle prices coming down. I think some of the retailers or manufacturers start to decontent some of the vehicles.
Interesting. Okay.
I think that, and interest rates will come down. Hopefully we have 50, 100 basis points drop in the next 6 months. That'd be the hope. That makes a big difference. So I still think we're not going to have a revolution where, I don't think any factories are going to go broke like they did in 2009 during the Great Recession when General Motors and Stellantis rolled over and died. I mean, Stellantis stock price is still really high. I mean, it's still worth, $70 billion in equity value, something like that for Stellantis. Nissan's not, I don't think, going broke either. If anything, the Japanese government is going to prop them up. They're not letting Nissan go away. We may see some consolidation of brands. We might see China owns Volvo. Could they buy another brand? Could they buy a Stellantis? Maybe.
they're not going to buy Nissan. The Japanese government, I don't think will let a Chinese company buy that brand. So I don't think we're going to see anything really big change. I think we're going to see things get better for consumers in terms of being cheaper. I think we're going to see profits decline for auto retailers. They're going to get a little worse for them. But I still think it's going to be very good in terms of the ongoing profit in the next 12 months at least.
Out of curiosity, are you seeing any brands rising quickly in valuation, like outlier brands that we're not thinking of?
The biggest lift in brands that I saw last couple of years was Hyundai and Kia. During the pandemic, they had supply and they had really good product.
Yeah.
So the blue sky value, the intangible value,
Correct.
goodwill value for those stores grew more in the last 3 years, than any other brand. Is that going to continue? Are they going to continue to take share, which they have? It's possible. And those brands were mostly about new car sales. They weren't very strong on used cars or fixed operations. My guess is that'll become a more balanced business model. So I could see those brands becoming a little bit more durable over the long time, more comparable to Honda, perhaps Toyota.
Alan, as usual, we're going to link the Haig report in the show notes below. So if anyone wants to read more, see some of the slides that you shared and you spoke about the numbers, it's going to be linked below and anyone can access it. Alan, always a pleasure. Thanks for coming on again.
Yeah, thanks for having me.
All right. Hope you enjoyed that episode. Please give the podcast a rating, consider subscribing to the show, and check the show notes for links to what we talked about. Thanks for tuning in. I'll see you guys next time.